Hi, my name is Jordan Wilson. In today's episode, we're going to start taking a look at how to construct an investment portfolio. Previously, we've covered target asset allocations. We've looked at some investments, whether you should invest in individual assets like stocks or bonds. Should you look at mutual funds, exchange traded funds? So now we want to start bringing it together into the actual investment process. Our objectives today, we're going to look a bit at investment accounts, some other investing vehicles that you can use, and then we're going to do an overview of the lump sum versus dollar cost averaging debate. Okay, when you start to invest, you've got a few decisions that you need to make. The first would be, where do I set up an account? Now, do I use my current bank? Do I seek out a independent or a specialty brokerage house? Where do I want to have that investment account based? I think in general, for most retail investors, the easiest course is usually the best. So if you bank with Citi, Bank America, Royal Bank, CIBC, just use your in-house investment arm. And the reason I say that is, in today's world, there's really not a heck of a lot of difference between online brokerages. In the old days, there was a lot of differentiation. If you go back long enough, you had the full service brokerage houses, which charged you a small fortune, but they provided individualized service. Whereas now you just go online, you put in a buy or sell order, press a button, and it's executed. So it's much more of a commodity these days. And again, when I came back to Canada in 2007, I was surprised at how few online brokerage houses in Canada, including the banks, offered me the ability to trade equities outside North America. Today, there's much more flexibility in the type of investments that you can make via an online brokerage house. That said, if you do want to specialize in a niche area, maybe that's day trading, maybe that's trading options, maybe that's investing in African equities. You might be best by looking around, comparing prices and the service offering, because in those more niche areas, you'll still see a bit of differentiation. The other area to consider is what I list here as small brokers, the independent brokers. In Canada, let's say Questrade, Qtrade. Both have very strong reputations, and hopefully that's because this is their business. They're not a bank with a wide variety of revenue streams. They're providing online broker services. So if they don't get it right, then they're out of business. And I must say that it takes a bit of a step up in quality or perceived quality to attract people that probably have their original banking relationships with Royal Bank or CIBC or Montreal. So to attract that money into a separate account, they have to have a very good reputation. Now, my only concern with independent brokerage houses is that they're not part of that huge bank system. Now, I'm pretty confident, although I guess over the last 15, 20 years, maybe that confidence has waned a bit, but the Royal Bank of Canada's, the Bank of America's, there's little probability that they'll fail. And as we see, those are the people that will get bailed out. But again, if I'm just a small independent brokerage house, maybe if there are financial difficulties, that could be an issue. Now, the way investments tend to be structured is that you're not going to be losing money because of the insurance on the cash and things being registered in your name. But there could be, if there is a financial disruption, delays in accessing your account, delays in getting your liquidity out. So a small concern. And I think the other issue that you just have to watch at times is that with the smaller houses, do they have the infrastructure, the capacity, if there is a huge market correction, or will they suffer as far as their ability to process orders? And you do see that occasionally with some of them. But again, I think they tend to do a fairly good job. It's just two smaller caveats that you should be aware of when you're doing your comparisons. And then I've got a comment here on eggs in one basket. And that can be good or it can be bad. Now, what I mean here is that I have an account with Royal Bank of Canada, RBC. And it's got my home mortgage, it's got my line of credit, it's got my credit cards, it's got my investment accounts, it's got my checking accounts. Everything I do financially is with RBC. Now, in the one sense, that's good, because if I go in and I want to negotiate a new loan, they know how much money I actually spend with the bank on a variety of services. So they see that holistic value that I bring RBC. And that should get me a better deal. Sadly, often it doesn't, but that's more of a bank issue than a me issue. Now, on the other hand, if I've got $3 million and I place $1 million with RBC, $1 million with CIBC, and $1 million with Toronto Dominion, I have 1/3 the relationship with RBC, but if I go into RBC to get a loan, I can say, hey, I've got $2 million in other banks, right? Can you, take a look and see what you can do, and maybe I'll bring some of my money across. And that's a huge driver for financial institutions, is that generation of what they call net new money. So as they increase assets within a financial institution, that looks good on their bottom line. It looks good to their investors. So there's a lot of value in the perception that you have the capacity to bring in additional wealth to an institution. And then conversely, while I'm having that conversation with RBC, I'm having that same conversation with the other two banks saying, hey, I'm talking to RBC about a loan, but I'm not fixed on dealing with them if you guys can pony up with something as well. So you can play one off against the other. And I think the final thing I'd just say with banks in general is that money is a sticky asset. And it's sticky in the sense that people on a behavioral basis tend not to change their banks as often as they probably should. It's kind of a pain, right? You've got your direct debits and your direct deposits with your bank account. You've got credit cards, you've got a checking account, you've got all this relationship, you've got your mortgage with the bank. So it takes quite a bit of annoying you before you finally just throw your hands up and say, I'm walking across the street. And that's kind of, the frog in the boiling water. You find at times with these banks is they just annoy you and they nickel and dime you on little things that they shouldn't be charging you for, or weak customer service. And over time, the water gets boiling, but you've been in a relationship so long with them that you don't notice it. And that's intentional on their part. but it's also something to be aware of. And I think that what people don't tend to appreciate maybe is that money is just a commodity. Like it's just a thing. It's like a computer. It's like a car. The bank is in the business of selling and buying that money. So they take in a loan, or they take in a deposit for me, and then they turn around and loan that out at a higher rate to somebody else. And that's how they make money. So they want your money. They also want to do business with you as far as giving you a mortgage or a loan, because that's, again, revenue generation. But it's almost like a doctor's relationship with people. They think, oh, it's my banker, it's my banker. No, they're basically like a car salesman. And if you treat them like that they're in the business to make money and it's not this religious experience, then it becomes a easier relationship to deal with and to make changes. So just something to think about. Now if we move into, we've picked our financial institution. What kind of accounts do we need? Do we need tax deferred accounts? And in Canada, that might be your RRSP. Could be tax-free accounts like the TFSA. In the US, you have the IRAs, the 401ks, or on the more tax-free side, the Roth vehicles. So what type of vehicle do you want? Do you want a taxable account? Do you want a tax-free? Do you want a tax-deferred? That's sort of decision one. Now in the old days, and I can't really speak on the IRAs in the States, but in the old days in Canada, you had the RRSPs. You didn't yet have the TFSA, so you just had the tax deferred. And what you could hold in the RRSPs was relatively restrictive. You had limits on your foreign holdings. You had limits on the type of asset classes that you could place into an RRSP. You had restrictions on the annual contribution limits to a much greater extent than you do today. Today, the RRSPs and the tax deferred or tax-free accounts are a lot more flexible, both on contribution limits, the carryover of unused contribution limits, the type of assets that you can hold within an account. So a lot more flexible. And I think that for most retail investors, and that's presumably you and I, you probably don't have enough capital or wealth accumulated, or you don't earn enough on an annual basis to need a separate account that is taxable. So that if you fully max out on your TFSA and your RRSP, you probably don't have anything left that you need to invest somewhere else. So that would be the first thing. I think most people don't need a taxable investment account. They can make do with tax-free or tax-deferred options for the most part. And as I just said, today the investing is a lot more flexible so that you can hold the right variety of assets in that account. Now the caveat that I'd put in just as an aside is that in Canada, you'd probably, if you followed my investment beliefs, you're probably best off with a self-directed plans, because that gives you the maximum flexibility. And if you don't get a self-directed plan, you're often just stuck with the choices of your bank or investment house. So I think that's probably the first thing, is I don't think that you need taxable accounts. And a large part of that is what we discussed with compound returns, in that you want your money compounding on your behalf in your account. And taxes are a huge drag. And when we talked about the compound returns, we saw that the income that you earn on prior periods income is what supercharges your compounding. So if you're in an account where your income is being sapped by 30 or 40% due to taxes every year, that destroys your ability to compound your returns. Whereas if that's in a tax deferred or a tax-free account, that full 100% of income will start earning income of its own, which in turn will earn income of its own, and so on and so on. And that's the big driver for wealth accumulation. And then the last point on this slide would be, do I want a cash account or do I want a margin account? Now, a cash account is you buy what you have available in cash in the account. Margin allows you to leverage your account assets. And it's a formula that looks at your existing assets and what you're buying and how much leverage does that provide to add more that you don't actually have for cash. So you're basically borrowing money from the bank to top off your investments. Now, often, or in all cases, margin accounts will not be available in tax efficient or tax free accounts. But if you're in a taxable account, maybe you consider setting up a margin. Now, in some senses, I think leverage can be good if you know what you're doing. And it's debatable if any of us do, but if you know what you're doing, then instead of earning maybe a 10 or 20% return on buying shares of Apple or Amazon, you can leverage that up. And again, supercharge your return to maybe 30, 40, 50%. But conversely, if the market's crater, then you can get in trouble, especially if there's margin calls. And if there's a margin call, you may have to liquidate other assets to cover that call. And in a down market, that may not be prudent. So there's pros and cons to margin accounts. I'm not sure that you need them to be successful. And even if you do, I think that in, say, a tax deferred account where you may not be allowed a margin, there's still investment products out there that have margin built into them. So you might see a 3 times bull mutual fund, and that basically leverages perhaps the S&P 500 by 3 times or 2 times. So you can buy some products that have some leverage built into them. Now, the other thing that it's not a huge issue, but just something I thought I'd point out is other investment opportunities. So you've got your RRSP or your IRA set up. Great, that's your bulk of your investing. But you also probably have some investing opportunities, maybe through your employer. There could be employee stock purchase plans. That's if your company you work for is a public company. But you'll also see possible phantom plans that exist for private companies. And that sort of gives the employee a chance to share in the performance of his or her company. And with the phantom plans, that would be a private company that they couldn't buy into otherwise. Now, often with the employee stock purchase plans, there's a deal involved. So you're buying often at a slight discount to market, and you probably aren't paying any brokerage house fees. So those can be useful. And another useful part of it is that at least at a higher level of employment, it shows that you're buying into the company, that you believe in the company. And in my case, when I was at UBS, that was actually looked upon as how much of my stock options did I sell every year and how much skin in the game did I have with UBS. And that, to some extent, impacted your promotability. If you don't believe in your own company, why would I promote you higher? You also see defined contribution plans and defined benefit pension plans. And with a defined contribution plan, you tend to have a choice of mutual funds that you would invest the contributed assets. So every year with a defined contribution, you and or the company will invest a certain portion of your salary or a fixed amount into a pension plan. And again, that might be a single balanced fund. It might be a choice of 5 or 6 funds that you can allocate. So there's another area that you'll be investing in. And you need to keep that in mind, because when we look at your total asset allocation, you have to consider that portion as part of the whole. Defined benefit pension plans, less of an issue because they tend to be based on not investing in a stock or a bond or a mutual fund, but maybe it's a percentage of your last 3 years or 5 years salary. So it's more of a, okay, when you retire at age 60, this is the annual dollar value that you're going to get in a pension, presumably adjusted for inflation. But again, something to factor into your overall investment scheme. There could be also investments that generate other investments. So a direct stock purchase plan, you're buying stock directly through the company, not through a brokerage house. And that has its pros and its cons, but a big pro is that you're not probably paying any brokerage house fees or transaction costs. Maybe you have convertibles, preferred shares, bonds that are convertible into equities, for example. So at a certain point in time, based on price or based on the actual date, you may have the option to convert those bonds into equity, common shares of the company. Or maybe the company has that option at a certain valuation or date. They can say, oh, we're cashing in those bonds and we're giving you stock in exchange. You might see warrants, options, these type things where you're buying an asset and that gives you a right for a certain period of time to exchange that asset into, say, common shares of the company at a certain price. And the final one that I'll mention, and I separated it out, is the dividend reinvestment plans. And unless you're, let's say, a retiree that requires ongoing cash flow to supplement their pension or other income, usually I want people to tick the box. And if you go in to make a buy order for a lot of investments, equities, or definitely mutual funds or exchange traded funds, there's always going to be that option. Do you want a DRIP? And the answer tends to be yes, because that also helps you compound your results, because you're not getting the dividend that comes out of Coca-Cola or General Electric in cash that'll sit in your account and then you've got to do something with it. It just says, here's the dividend. We're going to convert that into the equivalent shares and we'll just add to your account. So that's basically compounding all on its own. So that's something that tends to be quite useful, especially in tax deferred or tax-free accounts where you do want the money to sit and accumulate. So the big debate, I think, in investing, or at least one of the debates, is lump sum versus dollar cost averaging. How do I construct that portfolio? I've decided on the bank, I've decided on my account, an IRA or an RRSP. I've decided I'm going to invest in mutual funds or ETFs. So should I buy them in one fall swoop, or should I purchase them over a period of time? And the lump sum, you accumulate your capital if you don't already have it, and then you invest everything at once. And I think for most people that they do need to accumulate over a period of time, because you're not usually sitting around with 10 or 20 grand in cash just to invest. And in Canada, when you come in February, you see people lined up at the bank to get their RRSP loans, whereas the right strategy is that they should have invested in the RRSP the prior year on January 1st, so the first day of eligibility, to again maximize the time frame and the compounding. But people just don't have cash sitting around, and that's understandable. So if you lump sum invest, there's a good chance you're going to have to accumulate capital over time and then buy everything. Now, this isn't a market timing strategy in and of itself, but often investors use lump sum investing as part of their market timing strategy. So if I'm going to invest $10,000 and I don't have that, and I'm building, and then suddenly on June 30th, I've got my 10 grand, maybe I say, well, you know, the markets are a little hot right now. I'll wait another couple of months. And if they cool off or there's a correction, then I'll jump in. And that's fine. I think, though, when we went through the issue in active management not being able to perform its benchmarks, the lack of alpha with active managers, one of the large issues with that was the inability to accurately time markets. So yeah, if the markets are hot, you can hold off a few months before investing. But again, if we look at the professionals, they have a hard time timing the market. So there's no guarantee that if you wait a couple of months before jumping in, you'll get it any more right than they do. Now, lump sum investing is usually good in bull markets, because if you're buying on day one, January 1, 2020, and the markets are rising, then on December 31, they'll be higher than they were at the start of the year. So you're better off buying sooner rather than later. They also tend to be slightly better in flat markets. So if I'm buying 100% on January 1 with today's transaction costs, I'm probably paying like a $9.99 or a $6.99 fee to buy an exchange traded fund, regardless of the amount of money that I put in. So I'm buying that and I'm paying one fee. Whereas when we get to the dollar cost averaging and we're buying over a period of time, you're going to pay that $9.99 or $6.99 fee every time you make a purchase. So in a flat market, only buying once will save you a little bit of money. Now, the dollar cost averaging is exactly as it sounds. You don't invest everything at once. You build a portfolio steadily over time. And that might be, okay, I've got my $10,000 on January 1. If I was lump sum investing, I'm going to buy everything that day. But maybe if I'm dollar cost averaging, I say, I'm going to take that 10 grand and for the next 20 months, I'm going to invest $1,000 every 2 months. So bi-monthly, $1,000, and just over close to 2 years from now, I'll have my entire investment. Now, if the market's going up in a bull market, you can clearly see that you wanted to buy day one. And in a flat market, I'd much rather pay one transaction fee in the lump sum than spread that over 10 periods where I'm paying $9.99 times 10 instead of one $9.99 fee in the lump sum scenario. But if the markets are going to fall, or we're in a volatile market where they're up and down, then maybe we can smooth out our purchase price. Because yes, there'll be some up periods, but there'll also be some down periods where maybe that $1,000 will get me more shares than if I bought on day one. So down markets or volatile markets, dollar cost averaging might be the way to go. So that's kind of an overview just on some financial institution considerations, the different investment accounts that you might want to open, and then the lump sum versus dollar cost average debate overview. Next up, we'll take a deeper dive into lump sum investing when it makes sense and if it makes sense for you. And then we'll follow it up with a look at the dollar cost average argument. And I think that'll get us through sort of the portfolio construction side before we move into the ongoing maintenance of it. So thank you for your time today, and have yourself a good one.